Are you planning on selling your home, or have you sold it already in this past year and you're wondering whether you will owe the IRS taxes? If so, you're in the right place. In this video, I am going to explain what taxes you're going to owe for selling your home. And even more importantly, I'm going to share with you how to take advantage of a tax law, Section 121, that could save you up to $500,000 in capital gains. I will also explain how to handle capital gains on home sales over $500,000, how to navigate the ins and outs of IRS Section 121, and what to do if you don't qualify for the full Section 121 exclusion. So let's get started. Hi, my name is Sonia Narvaez, and to start things off, let me explain to you what is Section 121 exclusion and why it matters to you. The Section 121 exclusion allows homeowners to exclude up to $250,000 in capital gains or $500,000 if you're married from their taxable income when they sell their primary residence. Now, to qualify for the full Section 121 exclusion, you need to have lived in the home for at least 2 of the last 5 years. Here's a real-world example of how Section 121 exclusion will work for you. So now, imagine that you purchased your home for $200,000. You lived in it as your primary residence for at least 2 years. Now, you sell this home for $550,000, which results in capital gains, or does it? To calculate our capital gains or the profit we made on the home, we need to use this simple formula. Capital gains equals sales price minus purchase price minus capital improvements. What are capital improvements? I am glad you're thinking about this. Capital improvements are any improvements you made to the property. Things like bathroom remodeling, floor replacements, roof replacements, pool additions. They are all deductible when calculating capital gains. Now, let's go back to our example where we were. We sold the house for $550,000. So now, in order to understand where our capital gain is, we take the cost of the house when we purchased it, that was $200,000, and then we will also subtract the $50,000 we spent putting in that nice pool we bought last summer. Now, that leaves us with a $300,000 capital gains. But here's the good part. With Section 121 exclusion, it allows us to deduct up to $250,000 if you're filing a single, or $500,000 if you're married and filing jointly. So in our example here, you're single. You take the $300,000 in capital gains and subtract the $250,000 deduction. That'll leave you with a $50,000 capital gain. Now, it's important to understand that this $50,000 will be taxed at your income tax bracket level. Now, you're married, you're filing jointly. You take the $300,000 in capital gains and subtract the $500,000 allowed deduction, and that leaves you with 0 capital gains. Now, you owe 0 in taxes. Now, it's important to note that not everyone qualifies for the full deduction of Section 121 exclusion. In my experience, I have seen people make critical errors when selling their homes and getting stuck with some large tax bills because they failed to meet the criteria of the Section 121 exclusion. I really don't want you to make the same mistake and see you cut a big check to Uncle Sam. To take full advantage of the Section 121 exclusion and get the full benefit, you must have owned your home for at least 2 years, lived in this home as your primary residence for at least 2 of the last 5 years, even if you rented it part of that time. And third, you did not claim the exclusion on another home in the past 2 years, so no double dipping, obviously. Now, many people won't qualify for the full exclusion, and that brings up my next point, which it's possible to get a partial exclusion if you don't meet all the 3 criteria I just listed. So what happens if you don't meet the 2-year rule? That's where the partial exclusion comes in. This rule lets you claim a prorated portion of the exclusion if you move due to specific unexpected life events. So let's talk about some of them. Job relocations. That requires that you move 50 miles or more away. So for example, if your old job was 10 miles from your home and your new job is 60 miles away, you would meet the 50-mile requirement. Health issues that force you to relocate. For example, a physician recommends that you move to treat or prevent a disease or illness either for you, a family member, or a close dependent. These also can require relocating to a drier climate for respiratory issues or closer proximity to a medical specialist. Now, other unexpected life events include natural disasters like hurricanes, earthquakes, floods, death. This could be the death of a co-owner, a close family member, divorce, separation, a legal divorce, and even the end of a domestic partnership. Multiple births from the same pregnancy, like triplets, or more children unexpectedly. Other hardships can include a job loss or loss of income that makes it impossible to afford this home. And finally, if you receive significant property damage, you can qualify for Section 121 exclusion. But how does Section 121 partial exclusion work? I mean, if you're not getting the full credit, how much is the IRS willing to give you? Well, if you are single and you lived in that home for half of the required time, 1 year out of the 2, basically you will get 50% of the $250,000 normal exclusion. You can exclude up to $125,000 of your capital gains from taxes. Obviously, the IRS will need proof. Documentation is key. Things like job transfer letters, medical records, paperwork that supports your case should be documented and saved. If your situation qualifies under the mentioned exemptions, also known as the safe harbor rules, you may not need special approval. If you have any questions about how to take advantage of the latest tax saving strategies, book your free complimentary consultation with a member of my team. Simply click the scheduling link in the description below and pick the time that works best for you. We would love to help and meet with you.